Okay, in today's video I want to talk about what I'm considering right now as I'm investing in the stock market. And on this channel I always talk about that it's equally important to invest in your financial health as it is to invest in your personal health. So early this year we saw with the recent events that the stock market lost about 30% of its value, but then really rapidly regained itself of about 40%. Now the question is, what will happen the next 6 months of this year? Will we see a continued climb on the stock market, or will we see a decline once again? So stay tuned in this video as I will discuss what I'm considering right now as I will invest in the markets. Now, of course, as you know, this is not financial advice, even though I'm a guy with a master's degree in finance and who has also happened to work for some years in the financial industry. But what instead I would like you to take from this video is to get inspired and see what do I do and what can you do, because just getting a salary and put it into your cash account is not that good when you compare it to investing, for instance, in the stock market, where you have a strategy of staying consistent, putting money in, and then you will start seeing compound interest through the years, meaning that your money that is invested does not just grow, but also increasingly starts to grow, as of course here's the assumption that the stock market doesn't come down, which is of course in these current situations not guaranteed, but say in a theoretical scenario we would have a situation where we get, for instance, 10% return each year, then it will start to increasingly grow, as compound interest is exactly what this is. And actually this is one of the greatest concepts in finance when you consider personal wealth management. And actually Albert Einstein famously said that compound interest is the eighth wonder of the world, and he who understands it owns it, but he who does not pays for it. So what I want to discuss today is that we are in a situation which is really, of course, rare, and nobody knows whether we are going up or down in the stock markets. So in today's video I want to first discuss the bull scenario, which precisely means that why it would still be justified for the market to continue its rise even though the economy is not doing that well. And then I also want to discuss the bear scenario, which means that the market would start to decline, which is of course really justified when the economy itself is not doing that well. Alright, so first off I want to start with the bull scenario of why would the stock market continue to climb up even though many nations' economies are not doing that well. Now, one thing that I need to mention here is that the stock market is not the economy, and the economy itself is not the stock market. Even though the stock market can be a sort of a guide and showing what the future, what lies ahead, it can be good in that regards, but it's still not, they are not the same, even though many people mix them together and seem to believe that they are the same, as there are many private companies out there, and of course then on the stock market are the publicly traded companies. Alright, so why would the stock market continue its climb? Well, in this video I want to focus specifically on the US economy and its stock market, as it is the leading drive engine of the world economy. Now, when we look back at last month in June, we could see that unemployment numbers in the United States were really high. A little under 20 million Americans were without a job. And this is of course very bad for the economy, as it's a very consumer-driven economy. Now, interestingly, during the financial crisis in 2008, we saw a situation where the stock market kept rising, even though the unemployment numbers also kept rising. But of course, we can't say that history is a guarantee of what happens now or in the future. Now, one of the reasons why the stock markets could continue their climb is that the Federal Reserve, which is the central bank of the United States, has basically come out and said that they will give unlimited amount of support by printing money and put it in to the economy, supporting the economy and companies as a whole. But one question, of course, remains here, that for how long is this actually sustainable to do? Now, another reason of why you would consider investing in the stock market is the fear of missing out. Now, the fear of missing out means that what if you're just keeping your money in your account because you're afraid of a decline in the market? Well, there's the dilemma here that the markets could still continue rising and then you're missing out. So that's also another driving force here, and especially if you look at, for instance, credit markets or bond markets, which are, for instance, loans to governments or loans to companies. If you look at the interest rates, they are very low, so they are not lucrative compared to the potential returns that you could get from the stock market. All right, and finally, on why the markets could continue rising is, remember, as we discussed earlier, the stock market is not the economy and the economy is not the stock market. So when we look at, for instance, an index which sort of tells what is the stock market actually doing, we have S&P 500, which basically gives you the 500 largest publicly traded, so not privately held companies, and how are they doing. So you take the 5 largest companies, which are Microsoft, Apple, Amazon, and Facebook, and Alphabet, which is the owner or the mother company of Google. And when you look at these companies, they are actually just 5 companies, but they are 20% of the whole value, the market value of this index S&P 500. And looking at their businesses and just thinking from common sense, these businesses are high-tech companies working in a digital space, and they are not really doing that bad in the current situation, despite all that is going on. Okay, so then on the other hand, we have the bear scenario, why the markets, stock markets could decline. And looking at what is going on in the health situation around the world, it could go worse, and it's actually not doing that well, and especially considering the United States. And the stock market is currently not reflecting this. And when you look at what is going on in the economy, and if we have a situation where they have to shut down again, then how will this affect the consumers in the economy? It's likely not going to do that well, or you could assume that this would be reflected in the stock market. And why I say that the stock markets might not be reflecting what is currently going on around the world and why they could be possibly overvalued is, for instance, if you look at this Shiller PE ratio, and this ratio is actually not that complicated. What it does, it, for instance, looks at the S&P 500, which again is the 500 largest publicly traded companies in the US, and looks at their price divided by their earnings. So here you can see that it's close to the price, this multiple is close to 30, which means that you are paying 30 times the earnings of the companies compared to what is the average, historical average is a little under 17. And this means that you are actually paying a lot more for these companies, and when you think about it, is it justified when you have everything going on around the world? And what if the US has to shut down? I don't think the earnings would possibly, at least that wouldn't be a positive thing for many companies. And here is then the dilemma that is this justified that the ratio is so high? On the other hand, you of course have that the Federal Reserve is stimulating, putting in money into the market. But also when you look at, as an investor, you're looking at what should I invest in? Okay, the market might give you return, so you keep investing there, and that's why it's so high. And on the other hand, you might be considering, are the news actually that bad regarding of what is going on out there? So whether this PE ratio is justified or not, is it overvalued or not, is to look at the quarterly earnings which are released every quarter, that the companies show that what is their financial performance. So now during summer we will see when they release their earnings, and also during fall and later in the winter, that what is the direction of these companies? Is it bad or is it good, or where are we? All right, so whether or not you believe that the market will go up or down or even sideways, one thing is for sure, that it's really hard to pick out the winners in this situation or overall, and that is why I always say that you should, or at least something I do, is diversification. So not putting all the eggs in the same basket. And also the timing is quite hard here, as you don't know what's going to happen next. So you need a plan if you want to stay consistent and stick to it. And whether we are going up or down, you always stick to this. And this is something I will discuss in the next video on how I plan to diversify, and also what is my pacing of doing these investments. But one thing is for sure, we need to stay optimistic about the future, invest in ourselves, and some of the pieces of the puzzle are to invest in your personal health and wealth. All right, thanks for watching. Like the video if you found these tips useful. Comment if you have any perspectives on investing in the market, and subscribe if you want to see more content similar to this, and I'll see you guys in the next video.